30 Key Takeaways from Chapters 4 to 6 of The Psychology of Money by Morgan Housel, with each point illustrated by a real-life example or story. Chapter 4, Confounding Compounding. 1. Small gains, big impact. Takeaway: wealth is built through small, consistent gains that compound over time rather than from one massive win. Example: Warren Buffett's fortune grew enormously not because of one big bet, but because he reinvested modest returns consistently for decades. 2. Exponential growth isn't intuitive. Takeaway: our minds struggle to grasp exponential, compounding growth since we naturally think linearly. Example: a 6% annual return may seem small, but over 40 years it can turn a modest sum into a substantial nest egg. 3. Time is the most powerful asset. Takeaway: the longer you let your money work, the more pronounced the effect of compounding becomes. Example: an investor who starts saving in their 20s can amass far greater wealth than someone who starts in their 40s, even with the same rate of return. 4. Patience trumps timing. Takeaway: staying invested over long periods is far more effective than attempting to time market highs and lows. Example: investors who remained in a diversified index fund during market downturns benefited as the market eventually recovered. 5. Consistency over perfection. Takeaway: regular disciplined investing, even if it's a small amount, beats sporadic larger investments. Example: dollar cost averaging into a retirement fund helps smooth out market volatility over time. 6. Reinvestment is key. Takeaway: reinvesting earnings, dividends, or interest accelerates the compounding process. Example: many long-term investors reinvest dividends, which helps their portfolios grow faster than those who simply withdraw payouts. 7. Minor advantages add up. Takeaway: even a slight edge in returns, when compounded over decades, can lead to enormous differences in outcomes. Example: two friends investing the same amount, one earning 7% and the other 8% annually, will see dramatically different totals after 30 years. 8. Avoid disruptions to compounding. Takeaway: interruptions, like withdrawing funds early or frequent switching between investments, can undermine the benefits of compounding. Example: a retiree who cashes out during a downturn may miss the market recovery, losing the compounding benefit. 9. Linear thinking underestimates growth. Takeaway: most people underestimate compound growth because they expect steady, linear progress instead of exponential leaps. Example: calculating future value using simple addition gives a far lower estimate than using exponential growth formulas. 10. The magic of just waiting. Takeaway: sometimes the best action is to shut up and wait while your investments work their magic over time. Example: Buffett's advice often centers on holding investments long-term rather than reacting to short-term market noise. Cover. Chapter 5, Getting Wealthy versus Staying Wealthy. 11th, different skills for acquisition and preservation. Takeaway: the strategies to build wealth, risk-taking, and seizing opportunities differ from those needed to preserve it, frugality and caution. Example: a startup founder may take bold risks to grow a company, but must adopt conservative strategies later to safeguard profits. 12th, risk-taking to get wealthy. Takeaway: building wealth typically requires stepping out of your comfort zone and taking calculated risks. Example: early-stage investors or entrepreneurs often bet on innovative ideas, accepting volatility for potential high rewards. 13. Preservation requires paranoia. Takeaway: once wealth is acquired, protecting it demands a healthy dose of caution and skepticism, almost like financial paranoia. Example: Warren Buffett's later years show a focus on avoiding debt and preserving capital rather than chasing high-risk ventures. 14. Avoiding ruin is paramount. Takeaway: it's more important to avoid catastrophic losses than to pursue the highest possible returns. Example, a portfolio that loses everything due to over-leveraging is a failure, even if it had moments of high performance. 15. Margin of safety is essential. Takeaway, always build a buffer, or margin of safety, into your investments to withstand unexpected downturns. Example, investors maintain emergency funds and diversified portfolios to protect against market crashes. 16. Survival over spectacular returns. Takeaway, long-term financial success depends more on survival, avoiding large losses, than on picking the perfect investment. Example, a diversified strategy that avoids ruin allows an investor to remain in the game long enough for compounding to work. 17. Humility and wealth preservation. Takeaway, staying wealthy requires recognizing that past success does not guarantee future gains. Example, many wealthy individuals live modestly and continuously reassess their risk instead of getting complacent after a few big wins. 18. Balance boldness with conservatism. Takeaway, the balance between risk-taking for growth and conservative behavior for preservation is key to long-term success. Example, a seasoned investor might allocate a portion of assets to aggressive growth while keeping a significant percentage in low-risk bonds. 19. Avoiding overconfidence. Takeaway, overconfidence can lead to reckless decisions that jeopardize wealth preservation. Example, during bull markets, some investors over-leverage, only to be caught off guard in a market correction. 20. Adapting to changing circumstances. Takeaway, strategies for getting wealthy may need to change as you age or as market conditions shift. Flexibility is critical. Example, an investor shifting from high-growth stocks in their 30s to dividend-paying stocks in retirement to reduce risk. Chapter 6, Tails You Win. 21st, outlier events drive success. Takeaway, a few rare, extreme outcomes, tail events, are responsible for most of the overall returns in investing. Example, venture capital returns often come from one or two startups that generate massive returns offsetting many failures. 22. Embrace imperfection. Takeaway, you can be wrong more than half the time and still come out ahead if your winners are big enough. Example, even if 60% of an investor's bets lose, a couple of 20x returns can turn the overall performance positive. 23rd, diversification to capture tails. Takeaway, spreading investments across many opportunities increases the chance of capturing those rare, high-impact wins. Example, venture capital firms invest in dozens of startups knowing that only a few will be huge successes like Facebook or Uber. 24. Recognize the power of the extreme. Takeaway, the most influential outcomes in finance often come from extreme, unexpected events rather than average performance. Example, the dramatic rise of Amazon Web Services, AWS, transformed Amazon's fortunes despite many smaller, less successful projects. 25. Expect and accept failure. Takeaway, most investments will fail or produce mediocre returns. Only a few need to perform spectacularly. Example, many startups in a VC portfolio don't succeed, but the rare breakout company can deliver returns that dwarf all the losses. 26. Tail risk is part of the game. Takeaway, extreme outcomes, both good and bad, are inherent in the market. Learn to live with the volatility they bring. Example, market crashes or booms are often driven by tail events. Understanding this can help an investor stay calm during turbulence. 27. Patience is required for tailwinds. Takeaway, the benefits of tail events may take time to materialize, so persistence is crucial. Example, an investor might wait years for a breakthrough event, like a startup reaching unicorn status, before reaping massive rewards. 28. Emotional discipline during downturns. Takeaway, maintaining composure during market dips is critical to staying invested and capturing eventual tailwinds. Example, investors who sold during the 2008 crisis often missed the subsequent recovery, while those who held on benefited when markets rebounded. 29. Focus on long-term outcomes. Takeaway. Instead of fixating on daily market fluctuations, concentrate on the long-term impact of tail events on your portfolio. Example, instead of reacting to short-term volatility, a long-term investor in a broad index fund will benefit as the market's rare high-performing stocks lift overall returns. 30. Build your portfolio to withstand many losses. Takeaway. Structure your investments so that even if many fail, the few that succeed can drive overall wealth. Example, a diversified portfolio in emerging markets may see many losses, but one breakthrough company can deliver a return that makes the overall investment highly profitable. These 30 takeaways from chapters 4 to 6 of The Psychology of Money illustrate how small, disciplined gains, risk management, and the acceptance of rare high-impact events all play crucial roles in building and preserving wealth over the long term. Each point is backed by real-world examples, from Warren Buffett's compounding journey to venture capital's reliance on outlier successes, highlighting the power of time, patience, and psychological insight in financial success.